Hey, it's Wayne from Visionary Wealth Management, and it's been a unreasonably, unseasonably stable year for the markets, short of that little adjustment and quick comeback we had in the March-April timeframe this year. However, with where the markets are right now, I need to communicate to you as our clients that I'm not fearful, but I am more pensive than I have been in probably the last 15 years or so, with regard to where the markets are and how precariously they are positioned. I want to go through a few high-level stats. We've covered a little bit of this in some of our written commentary, but I want to give it to you here now because this impacts how we're thinking about what to invest, how to invest new money, new cash that may be coming in, bonuses, stock grants, inheritances, cash that's accumulated, those kinds of things. It also impacts how we are approaching, if you're on a glide path and landing at retirement or at some kind of a pivot point, how we're approaching are we planning for 5 years, 7 years, 10 years worth of cash flows right now? And so let's get into a few of the specifics with regard to the market. Right now in the US stock market is 8% of the market cap of the entire US market is one company. It's Nvidia. Nvidia is valued at over $3.7 trillion, larger than the entire economies of most European nations and half of the South American countries or more. Bigger than multiple countries like Germany and Italy put together, bigger than their entire stock markets combined. One company. 10 companies make up 35% of the market cap value of the entire US stock market. And the tech sector makes up 61% of all market cap for the entire index. So when you put $100 into the S&P 500 stock index, 61 cents, 61% of that dollar is going into the tech sector. Now, there are 11 sectors in the economy. I am a fiduciary legally bound to act in your best interest. And I need you to ask yourself this question: what set of circumstances do you think would need to exist for me as a fiduciary acting in your best interest to put over 60% of your money in one out of the 11 sectors of the US economy? It's a hard question to answer, right? But that's where we are. So we are hyper concentrated. This is against the backdrop right now of, we also have a real estate bubble. We also have gold that's been on a runaway. We also are actually considering adding a small portion of gold for the first time ever. That really has more to do with Basel III banking regulations and the status of gold as a tier one asset, which half of you I know just glazed over when I said Basel III banking regulations, and you were like, okay, you just lost me, Wayne. I get that, I understand that, but that's a different conversation, a different topic for a different day. But here's some of the other things. You heard me say things like canaries in the coal mine. So let's talk about some canaries in the coal mine. Right now, we have $2 trillion worth of student loan debt. We have an astronomically high, historically all-time high by exponentials, like 3 or 4 times higher default rates or delinquency rates on student loan debt than's ever existed in history. The same is true for the $1.3 trillion credit card industry. The same is true for the multi-trillion-dollar used car debt industry. So we have at least 3 or 4 categories of debt. Oh, by the way, that's before we get to the multi-trillion-dollar sector of commercial real estate mortgages. So all of the vacant office buildings and vacant strip malls and vacancies in consumer malls and shopping malls and retail malls or retail strips that we see. All of that is at record high delinquency or default rates. I had a conversation with a group of bankers last week, and they said they've never seen the kind of carnage that they're seeing right now in commercial real estate. Residential real estate is gold. We got way too many buyers, not near enough supply in the market. We've got huge demand, and our economy is continuing to grow and add value, and residential real estate will continue to be a great place to invest. But we have many other sectors that are canaries in the coal mines where the debt in these spaces is really sending off alarm bells. And so the question is, what's safe? Because the US dollar is also down almost 11% in the first 9 months of this year. And so that's not, the US dollar is not safe. Multiple kinds of debt are not safe. What's safe? What's safe has been, up to now, has been gold, residential real estate, and technology stocks. Might technology stocks be overpriced? I would argue yes. Might residential real estate be overpriced? I would argue yes, although it's not, the dynamics there are much different than technology stocks. So we are concerned about the hyper over concentration in technology in just a very few sectors of the market: residential real estate, gold, and technology stocks. We're very concerned about some of the canaries in the coal mine that we're seeing. It's our job to be helping read the tea leaves. We're not going to get this right all the time. We've been early before, but we are wanting to stay very diversified in our approach. And I think you would also conclude that there's virtually no set of circumstances that should exist where we put over 60% of your money in one sector. And so we're not doing that, and we are not going to do that. But we want you to be aware of how we're thinking, the data points that we're seeing. We want to envision the conversation, embrace and invite the conversation. If you have questions about portfolio allocation or why you see things shifting this way or that way within the portfolio, by all means, never hesitate to reach out. We're always here to help you envision more and to help accelerate your wealth through multiple generations. Here at Visionary Wealth Management, it's always our pleasure to answer your questions. Thank you for taking a few minutes with me here. Take care.